Good morning, good morning, good morning, everyone. David Johnson here, once again, kicking off our weekly broadcast, Thursday, 10 a.m. again. Just been reminded in our preamble chat that England, the USA, and Australia have all reached the last 16 of the World Cup. So that keeps a number of people involved in the broadcast very happy for now. And that friendship, guys, can very quickly change though. If two of those nations meet each other, there has to be a winner, there has to be a loser.
It's sport. We all love each other.
Well, there's a few derbies in the UK calendar in Scotland and England that, yeah, might you might struggle to use that description. But anyway. So morning once again to our broadcast. Morning to Sam, our special guest today. Saam Lowni, how are you?
Morning, morning, morning. Thank you for having me.
Fantastic. Looking forward to hearing from you in a moment. So, kicking off then, for anyone who is joining for the first time or listening to the recording on our YouTube channel, my name is David Johnson. I'm the CEO of a company called Leo Crowdfunding, and we are an equity property crowdfunding platform. And we put these on every Thursday for around about 30 minutes for a market overview, some special guests and topics. Sometimes we talk about projects on our platform, and above all, it's designed to give a bit of education and market knowledge. And no better man to provide that as my co-host, Mr. John Corey. I'll let him introduce himself.
John Corey, Property Fortress, coming up on 40 years of investing in property. Started when I was, 20 something? Yes, I am that old, OAP. Interesting that we have all these changing regulations on today, December 1st. There's a slightly, for those that care, a slight wave of changes from the FCA today, and then a little bit in Q1 next year, all off of a new policy statement came out during the summer. So you'll notice your risk warnings are changing, folks. Everybody pay attention, do read your documents, and notice those risk warnings.
Mm-hmm. If Brenda's watching the broadcast, John, she's probably throwing a cup of tea or a spoon at the screen right now. I know a number of people have contacted me this morning saying they didn't get their weekly update yesterday. So they were just confirming was the broadcast still on or not. So John's referred to risk warnings there. And we didn't quite get agreement with our FCA principal over which risk warnings were appropriate. And unfortunately, our weekly update was not approved to go out in time for the broadcast. So apologies for that. We've had to scrap it, and hopefully we'll get the whole risk warning issues settled over the next couple of days, and we'll be back to normal next week. But if you are looking for a weekly update this week, unfortunately, there will not be one. So let's get on with today. So last week I was on the road once again. So a quick CEO on the road slide. This is a location that Sam I know knows very well. He's involved quite a lot in the Central London property meet run by Brendan Quinn. And I was there last week, which it was in the diary to be there. I hadn't been for a few months, but lo and behold, one of our fundraisers, Rosie Cassidy from Newman Rose, was actually on the panel. And AJ Kapoor, who's also one of our fundraisers from PLMD, was also in attendance. So yeah, it felt like home, but a really good event. And really, John, the one of the guest speakers on the event leads us into our market update. And I'll bring Sam in at the end to comment on this because this is his space as well. But very, very interesting input from this guy called Bruce. I haven't worked out how to pronounce that second name. Sam, maybe you know, is Mainwaring, or is it sometimes pronounced Mannering?
So it's not Mainwaring, it's closer to Mannering. He's
No,
Australian, I believe.
I think it's
Oh, you've gone frozen on us, Sam. So if it's closer to Mannering anyway, the most important thing is he did a very interesting talk, John, on his take on the market. And it was quite fascinating because he obviously based it not just on opinion, but on a lot of real data from 2008, 2009, and now. Um, so just to give you a chance to comment on a couple of these things, the topic really was, will there be a market crash? And he was like, no, I don't think so, and here's why. So his first big point was the 5-year swap rates have already come down the last couple of days from 5.5 to 3.8. This being the money that the mortgage companies would be borrowing effectively to then relend. and therefore it really sets the price that they can charge effectively for their money. So he's indicated this is already sort of tumbling down from all the forecasts of it going up to 8, 9, 10%. So I don't know what your thoughts are on that.
Yeah, I
I
mean,
mean,
sorry, I think I agree with Bruce for the most part. I don't, the definition of a crash is sometimes a bit relative or a bit vague. Some people would consider a 5-10% correction a form of a crash, and that's on average. Maybe in the Northeast it might be a little bit more volatile and falls further, but I certainly think that we are going to have some turbulent times in the next 12 months.
Yeah. And John, are you familiar with this sort of swap rate impact? Is that something that you're aware
I
of?
mean, this is pretty much all banks, all lenders borrow the money from someone, whether it's your deposits into a savings account or some other wholesale supplier. But the money is definitely flowing around, and there's a price for that money, and that price has already been decided ahead of time. So you can see what the forward costs are going to be. It doesn't mean what someone's paying in the future is correct, but at the same time, I think Bruce is making some very good points here, especially 1, 2, 3. When we get to under the notes, the second one, I have another comment.
Yeah. So in terms of obviously the Bank of England have certainly indicated that they had some brilliant graphs showing where 6, 7 weeks ago they were predicting interest rates to go, and they've now issued like a new forecast, which obviously is less. And is that what you're hearing, Sam, as well, sort of among lenders, that perhaps the forecast of 8, 9, 10% perhaps has been dialed back a bit? Is that fair to say?
Yeah. I mean, through the Trustonomics saga, they were projecting Bank of England base rate going up to 6, 7%, maybe even higher. But now it's down at a much more sensible level, about 4.75, I think was the max that I'd heard it from a month ago from the last Bank of England base rate rise. So that's already positive. But we are in a new paradigm in any case, and there will be some hurt along the way. So I think I think you just still have to tread with caution. Although I think there are great opportunities with a lot of people that have been through crashes in 2008 and know how to adapt. So you just got to be a bit more careful, but certainly it's undoubtedly there's some turbulence that we're weathering at the moment.
Yeah. And then certainly, John, you mentioned there the bottom bits, and this was certainly very interesting because I remember 2008, it impacted our own personal buy-let portfolio very, very heavily. Going from a nice healthy equity to negative equity in the matter of weeks. But it was interesting because I do remember the self-cert days. I do remember where you literally on a 2-page form almost, you were getting 100% remortgages. So he made a real big distinction between back in 2008, 50% of resi mortgages were interest only. So therefore, if the interest goes up, then obviously it's a huge impact on people's livelihoods and household expenditure. It's now only 20%. So 80% of the resi market out there has been unaffected in terms of their mortgage payments by this turbulence. And then the second point then just about obviously self-certs, low checks, those days are gone. And those who have received their interest-only mortgages or mortgages of any type have obviously had to do more affordability checks. So you had a comment on that?
Well, 2 things. First, the one I said I had. The self-cert, they are starting to relax some of the checks. So possibly we're going slightly in the other direction. It won't filter through right away. But if they relax the affordability checks, then possibly we are moving away from being a bit safer. The first one's interesting. To 20% are interest only, and less than half the country have a mortgage. So that's like less than 10% of the country has a mortgage that we should be worried about. So to get a crash, you actually have to have forced sellers, people who have to sell for death, divorce, whatever reason, or because they can't afford their loan. And this suggests that even the people that have these types of loans with interest only, it's a small slice. So
yeah. No, and that's what came out from what Bruce was indicating. This is what's so different than 2008.
Mhm.
So, as you say, Sam, turbulence, yes, it's going to be turbulent. No one's disputing that, but I suppose it's the extent of the turbulence and the fact there's always turbulence, and we move forward.
So I remember when I moved to the UK in 94, the conversation was all about the housing crash related to, I think it was 91, 92, which was all tied into the economy, but also the removal of the ability to deduct interest. And that lingered for quite some time. Interest rates had hit over 15%. This is like chump change compared to that.
Yeah, no, that's a really good point. Okay, well, listen, a couple more slides before we get on to Sam. Those that were involved in the Becontree Avenue, Dagenham race tranche 2, it is actually now closed, reached its maximum target. So we had 180,000 raised from 31 investors. That is the update on that, which is excellent. So shareholder agreement is being sorted currently. So keep an eye out in your emails, and you'll be prompted to go and review the shareholder agreement when it hits your profile. So if you're invested in that project, keep an eye out for it. But another really good successful raise, and that was on the back of Church Road in Bristol reaching its maximum. I'm actually going to be on site next Thursday here, and the projects that Ed has, but raised 200,000 on this, which was excellent. And then now currently live on the platform is the Stafford Gardens. This is a planning uplift. I know from as of yesterday, I haven't actually checked this morning, but we've got the 96,500 from 32 investors. We only launched this last Thursday, so a really good start on this one. It's a planning uplift. It's definitely higher risk than normal development. And John, there's the new risk warnings you're talking about along the bottom there. So now all financial promotions on all our material, when it comes to anything financial promotions orientated, it actually have to say, don't invest unless you're prepared to lose all the money you invest. This is high risk. It's high risk investment, and you're unlikely to be protected if something goes wrong. And then on some of the material, there'll be a link that takes you straight through to the the risk pages. So certainly a bit more in your face, John, about the risk.
They're introducing positive friction. They want to slow people down so that they really do contemplate what's going on. The 2 minutes is to help people really understand the risks. This risk warning is not specific to a planning uplift. This risk warning is for any investment, including secured loans. So debt raises would be covered by this risk warning. They want people to realize that you will not necessarily get your money back. This is an investment. This is not a savings plan or anything like it. Yeah.
And as a platform, we welcome, if you like, that upfront risk being put out to the investors, so that there is no ambiguity. That listen, this is risk, and you shouldn't be investing if you don't have the appetite for the risk. So that's grand. Okay, brilliant. Let's get on now to our special guest today, Mr. Saam Lowni. I know you wear a couple of different hats. You have Merryoaks and some other business interests that you have, but delighted to have you on. Do you want to take a minute, Sam, to introduce yourself and your background?
Yes, thank you very much again for having me this morning. My name is Saam Lowni. I've been in property for 20 years, started out as an estate agent. The following year, I bought my first property, I flipped it, and I continued to do that through to 2008. These were houses into flats. These were simple refurbs, then doing side extensions, rear extensions, loft conversions, did a few commercial conversions before PD came out in predominantly across North and East London. And then in 2015, started investing a little bit further afield, so going out into Kent, the West Midlands, and into the Northeast. I'm originally from Durham, which is where I grew up. And I was looking for high yielding income producing assets, because that's probably where I've made the most of my wealth over the last 20 years. It's just buying and holding and enjoying the capital growth and then the income that comes off the back of it. So in about 5 years ago, I was a founding member of a lending business. It was development finance, grew a fund from 0 to 300 million. And I stepped down from that business in August of last year to set up Merryoaks Property Finance, which is a debt and equity advisory business. We provide funding solutions for SME property developers and investors across the UK.
And we have known each other probably now for, I'm guessing, about 4 years, I think, when we first met in London a few times. And you actually enjoyed a really special taxi service in Belfast on one occasion as well, if I remember.
Absolutely, being chaperoned and being shown the sights and the bright lights in Belfast as well when we hooked up that in that part of town. So yes, it was. We've known each other for a number of years, and I've been watching you grow Crowd Property. We've both been in that kind of finance space, providing finance solutions for developers, etc. So it's been a good ride so far, and it's never without challenges. But I think if you stay on the right side of some fundamentals, you can have some longevity with what you're doing.
Yeah, no, absolutely, and that's some of the things I want to get into now, just about some of those fundamentals. But I suppose you've covered your background. But why did you get involved in property? What was it about property that originally kind of floated your boat to say, not just as an income, but my career is going to be property related?
So it goes back to my childhood. My parents were always been into property. My dad's a businessman. He's always been an advocate for being into real estate. He used to buy these 2 up, 2 downs in the northeast of England, where I grew up in County Durham, and he was buying them for like £2,000-3,000, selling them for £4,000-5,000, back when the average house price in the UK was closer to 80,000. He took a break. Actually, we were talking about it before, in 1992, when the interest rates went a bit crazy and went into diversified into food and hospitality, that sort of thing, and takeaways. And one of his regrets was always that he never continued into property. In the meantime, my best friend at school, his dad was a big property mogul, had a chain of estate agents, and I always looked up to him. He used to have the biggest house. He took us to Newcastle United football matches, took us to the Lake District bike rides. So I was kind of wanted to grow up and be more like him. And when I moved to London to study, I got a job, and I always wanted to be an estate agent. So when my parents were always going around looking at houses here, there, and everywhere, I used to like the role of an estate agent. They used to dress smart, they used to drive nice cars, they used to be able to go and see properties and flats and houses in different parts of the country. And it was always fascinating to me. So I always thought I want to be an estate agent growing up. So when I did that, and then I started seeing the developers coming through the door as well and buying these recs, and then what they would be buying it for and what they'd be selling it for, just absolutely everything from playing Monopoly to being surrounded by these people. It was so obvious that property was going to be my profession and my career.
So I'm thinking here, John, I know you're an avid reader, John. So I've got two titles of Sam's life story book. It's going to be the UK version of Rich Dad Poor Dad. So you've got someone else that and it's their dad's kind of the one you want to be like, yep. Or it's just born to be in property. There's two. If you use either of those, yep, you can pay me some royalties.
I definitely saw the same thing, David, as you did. That it sounds like the Rich Dad Poor Dad story, that your dad does one thing, the other friend's dad does another thing. So
yeah. I mean, honestly, the guy had a huge property portfolio of properties across the northeast, and he used to come home with. I mean, he gave me a left because tenants would move out and they would leave stuff in the property. So he'd get a TV one day, a sofa the next day. He'd have a huge full train set one day, and then he'd have a left-handed golf clubs for me one time, tennis racket. Like, I was just like, this is the best job ever. You have the biggest house. You have all these goodies that come out of the back of these properties. Yeah, and he was naturally, even though Monopoly is a game of luck, he always somehow used to win.
Yeah,
actually, the interesting thing is it's about preparation and luck colliding or crossing, and whether you use military analogies or whatever. But if you're not prepared, you won't be able to take advantage of the luck when it happens, because volatility does happen, change happens. We see this interest rates, and we see this with motivated sellers.
Exactly. It's prepare. He used to tell me preparedness plus opportunity equals luck.
There we are. Another one to it. That sounds like a chapter in that book you're writing, Sam. Definitely. So in terms then of really getting into sort of the value for today, because we've got different people on now as attendees. We've got investors, we've got developers, we've got those just professional people in property, and of course then the recording will be listened by many people. So you talked about fundamentals earlier. If you want to share even a couple of those, and then just this current uncertainty that you talked about, is that forcing you to rethink your strategy, or how are you sort of embracing the change and uncertainty?
No, I mean, I think in general, it's the fundamentals are evergreen. I think, you basically you have to buy in areas of high demand. I think that that's generally a fairly assumed fundamental. I think from my experience, you need to buy in areas of strong rental demand as well. I think that's important. I think you always need to have a buffer on the income that you get. So there's a little profit margin at the end of every month, just in case you get interest rate fluctuations, you can, weather the storm. I think so you have to buy for positive cash flow, have the buffer, buy for the long term as well. So if you're looking at short term, trying to make money out of real estate, it's not impossible, but I think in general, if you're looking at longer horizons, I think you generally stay on the right side of kind of risk, and ideally, when you get into the deal in the first place, buying from motivated sellers as well. I think if you're buying it, or at least buying at the right price, a lot of the deals, the best deals were from making sure that as we used to always say back when I was an estate agent, you make your money at the buying stage. So buying right, buying for a profit, with having a good profit margin in there and a good buffer, buying in strong areas of demand. These are still things in the UK market, I think in any market, but in the UK market, especially where we've got a supply demand imbalance, where we're not building enough homes, we've got an affordable housing crisis. If you follow those fundamentals, you shouldn't go too far wrong.
Would you concur with that, John?
Yeah, I mean, the key is what Sam's highlighting is if you have strong cash flow, then you can weather the storms. It's very similar to having the right clothing when it rains, or being under a roof or in a car or something, that you can prepare for these things and you can then ride it out. And if you're getting monthly income and you're in no rush to sell, then it doesn't really matter what's going on in the short term.
Exactly.
Yeah. So in terms of your Merryoaks, then, what change have you noticed, say, in the last 3 months? So how's that affected developers' attitude to the deals they're doing? Have you had to change your criteria based on what the lenders are changing, or what impacts that have on you?
So it's definitely had some impact in that people are talking about it more, and they're treading more cautiously. I'd say that the main nervousness has actually come from the lender side. And I found actually a distinct difference between the lenders and the funders that have been around since 2008 and before, who have a lot more of a steady hand, whereas the ones that have started, the younger people, 2013, 14, 15, set up a lending shop, and now this is their first major turbulence that they're going through, and they're a lot more nervous. They're cutting back LTVs, they're increasing their pricing, and just or halting lending altogether and kind of restructuring their whole product range. But I would say overall, from a developer's perspective, again, it's a bit similar, but generally everybody needs to have some sort of activity and consumption in the market to be able to put food on the table, right? So lenders want to lend and need to lend, and developers need to continue doing what they're doing. And the ultimate crux of the UK market is that we still have this affordable housing crisis. We still do have a supply-demand imbalance. So if you're building the right kind of stock at the right price in the right area, you will still have demand. What you've just got to be careful of is GDVs. Make sure that they're not over-egged. Make sure that your build costs are watertight. And people, there's always a silver lining wherever there's a cost and benefit. They're saying, build developers that I've been speaking to, that they're already projecting their build costs for next year being slightly less than what they are this year. One of the main reasons is cost of labor is coming down. I mean, just on the south coast where I am, I know there's a few major house builders, and they're stalling on a few sites. They're just mothballing them. They're saying instead of building 4 or 5 in this region in the next 12 months. We're only going to maybe do 2 or 3 maximum. So the labor that they needed on those 2 other sites are not going to be there, and they'll need to find work elsewhere. So that's helping the SME property developers with some of their costings. But ultimately, yeah, I think you just have to stick to those fundamentals, make sure that you're not over-egging, not getting too excited about a rising property market, because a rising property market, the benefit is it kind of cancels out any mistakes that you've done. In this market, if you're building the right product at the right price, in the right location, there will still be renters, there will still be homeowners, first-time buyers, families that want to and need to move.
That's a really, go ahead, John.
So, Sam, you touched on something a couple times now that relates to this. And I was talking to a developer, and they had 2 loans called. They were in the middle of a project, or 2 projects, 2 different lenders. And they got a phone call basically saying, hey, we're going to exercise our right to call our loan. And in the contract, it turns out that it says they had 6 weeks. So middle of a project, digging holes, putting up stuff, ordering materials, labor's on site. And the lender says, I want my money back, and effectively freezing draws. And now they said, because you're a really good client, we'll give you 3 months. We won't force you to do 6 weeks. It's like, what? So I want to encourage people, and I want you to comment on this, but I want everybody to read their contracts, see what they're signing up for, see what clauses are buried down there. And these are development loans. There's a reason why this got called, and it did have to do with wobbles in the finance side. It had nothing to do with the construction. It had nothing to do with the direct lender, but that lender's money was getting called. And it was like a food chain of people saying, we need our money back. And all of a sudden, like, hits the coal face. It's like, whoa. So is that actually something you're aware of?
Yeah, 100%. So in developers' loan docs, they on development facilities, there will be a clause which is an on-demand clause, which allows the developer to call in the loan within a certain time frame. Could be 8 weeks, could be 12 weeks, on demand. Whenever they wish. Some of them put in a clause that it's only in an event of default that they can call it in. So there's variations of that. Some of them don't have that clause in at all, and you have to be very, very careful on who you sign up with. Now, a couple of things with that though. If you are going to have a loan facility that doesn't necessarily have that in, the likelihood is that you will be paying a higher interest rate. So one way or another, you're kind of paying for the security to have that in there or not. If you really want a very competitive interest rate, you're going to have to allow the development finance lender to have that little bit more security and call in the loan whenever they feel it's necessary for them. Now, in the background, most of these private lenders since 2008 are not high street banks with money, large swathes of money from deposits from custodian accounts. They are private lenders from private debt, private equity, high net worth, family offices, and they're an unregulated entity. So they can almost do and say whatever they want, and as long as you sign on the dotted line, you are obliged to follow whatever that contract says. And in the background, I've had literally one lender. It was fortunately not in the middle of the deal. It was before they completed and executed. They just said, sorry, our funding line's been pulled, so we can't do this loan anymore. We've been working on it for nearly 3 months and literally about a week or 2 away from completion. And they said, sorry, it's an American funding line, and they've pulled out the UK market entirely. And there's a number of kind of sub lenders that have been affected by this. So in those situations, what can you do? Or what's the lay of the land? Ultimately, you need to find funding from elsewhere quick, fast. You need to find an alternative solution. And if you are before you're in the loan, it's slightly easier. Although time constraints, if you're on a bridging loan that's about to expire and you need to get off that, it just causes a bit of friction and a bit of heartache for sure, but it's certainly easier to navigate. If you're in the middle of a development, it is more difficult, it is trickier, but not impossible. And there are lenders out there that are fully aware that this sort of thing is happening, and they're looking to capitalize on those sorts of opportunities as well. And there's a product that's called a finish and exit product, which will allow another lender to come in Some lenders do it, they like to be right at the end, and some lenders will take a little bit more risk and come in at any stage. It depends on how they're built internally and whether they've got like building surveyors and the right sort of team to be able to come and do the right checks at any phase of the development. So unfortunately, it is part and parcel of the risk that you've got to be fully aware of, and it does happen from time to time. Fortunately, it's few and far between at this stage. And since we've moved away from things like trustonomics, fortunately, it's seemingly going to be less likely. But this is not just in turbulent times. This can happen at any time where a lender is either in difficulty because of all kinds of other reasons. They've been irresponsible on other deals and been putting out capital here, there, and everywhere, and they've come short and they need to call in loans from elsewhere to balance the books. Or it could be more in times like that we're in now.
Excellent.
It's exactly what you said, Sam, that it was definitely the lender was getting the money from somewhere else. That somewhere else called the loan to the lender. The lender had to call the loan to the developer. The developer had zero default or zero technical reasons other than my lender wobbled. So
yeah, I think it's a really good point, Sam, you made earlier, and I hadn't thought of it at all. Actually, one of the benefits of this weekly broadcast is you learn something. The fact that lenders who were in the market pre-2008 have a different reaction to the current set of circumstances than those who are now finding themselves in the first wobble, the first turbulence, the first challenging times. I think that's interesting, for developers who are looking to source the right lenders. That's perhaps a factor they should look at. Those lenders have been around a bit longer. That makes sense.
The interesting thing is that I was very active in 2008, and the music stopped, and I admit I panicked. I stopped what I was doing. I thought that World War III was going to happen, and because you read the news and it's going to get worse before it gets better. Nobody knows how long this is going to take. It's like the 1929 depression, and after that we had World War III. So I was kind of going through all of those motions, thinking, oh my God, I better step back, and it is the end of this lovely run that we've had for so many years, and property is now dead, and all these other things. I started to believe what was in the media, and obviously it wasn't the end of the world. 2010 to 2015, actually, the property market grew considerably, and I went away and studied a little bit more about why these things happen and boom bust. And I already studied economics when I was at A-levels, but when you're going through it, the theory and the textbooks are quite different to going through it emotionally and seeing it in real time. And so now, and since then, I always promise myself, once we go through the next recession, I will be able to make money through a recession, as many, many wealthy people do. And I'll be fully more prepared for it, looking for the opportunities. And absolutely, I think it's, having read books like Rich Dad, Poor Dad, it just makes you better prepared to be able to make money in a boom or a bust. You just got to be, it's awareness. It's, I think, the most, I see these Facebook threads and people say, what do I need to prepare myself with the most? I'm about to spend, 50,000, 250,000. And one of the things that I kind of tell everybody that I work with, it's just awareness of what's going on around you. That helps.
Yeah, no, it makes perfect sense. No, some really, really good, some good points there. So, yeah, brand building. I know I get emails from you. You're obviously on LinkedIn, and then I get a blog in from you, and you're giving your opinion on the local, the current situation, the local area, etc. So how important is brand building for you, and what's behind that?
So I've been doing this for 20 years, so I feel like I've come a long way in a relative to others, and I've seen a few things, and my background as a estate agent, investor, developer, landlord, lender, and now finance broker, and having contact with solicitors and planning consultants, and just the full wide spectrum. I feel like, and I mean, I've known John as well for a number of years. I felt like I was somewhat reserved in the background, just seeing who's doing what, and over time, I feel that I do have something to say and something to share with the community. And I've just started to become a little bit more vocal about it. At the same time, I now have effectively a consumer brand, which is the Merryoaks Property Finance, where we provide debt and equity solutions for investors and developers, everything from buy-to-lets to HMOs to development finance, bridging, exit, commercial term loans, etc. So it helps actually also to generate more more conversations with the kind of client base that we're looking to work with. So I think it's something to give back to the community, kind of my two penneth on the way I see things. At the same time, it helps me grow my business and meet more people.
Excellent, absolutely fantastic. Listen, thank you for that today. It's been some really interesting insights and some takeaways on that. And yeah, speaking of brand building, what a perfect time to pivot into the next slide, which is this podcast that I've been talking about for a few months now. So I'm actually in London on the 9th and 10th, doing some pre-recording, particularly the intros and things like that. So similar to Sam, it's about just having a voice in the market and a place that you can share thoughts and share ideas and share experiences and all of that. And I know, Sam, we have talked about I know, I think you're planning a podcast at some point as well. Is
Yeah.
that
So
nearly there yet, or?
John's been on Property People, so we have John was actually my first guest that I had, and I messed up the recording, and it was probably the best interview that I had ever done. So never quite topped it. But fortunately, John was kind enough to come back again and do it. But that was over Zoom calls as well. So now I want to get back into a studio, which is how John and I started, and we've kind of put everything together to make that happen. And of course, David, you're going to be one of our guests in the coming few months.
Yeah, and vice versa. I think we'll probably have to do recording on the same day, where we'll record on yours and then to go for lunch and then come back and record on mine. But I'm laughing there, Sam. I think it's John's the common denominator. When John's on a broadcast or a podcast, it's his knowledge of tech and his computer science background. It's hard to deliver tech when he's there. Things go wrong. All right, John.
Could be. I created a pressured environment.
That's exactly that. That was what I'm looking for. The pressure's there. So this is again, just stay tuned for this. It's definitely coming. A lot of work in the background. Again, there's some compliance things around this, John, as well. Obviously, me being an approved person, there are sensitivities around what topics I can and can't cover without appropriate risk warnings, etc. So we're working through all of that. But it'd be good fun. And next week, John, you don't know it, but you know now. You are the guest. And we're actually going to be doing financial promotions and the FCA policies again around this risk warning stuff. I think it's really good to go back over it. We did it when the last policy statement came out in August. We had Karen on from the Investables, did a really brilliant slot on like the overview of the policy statement. But I thought it'd be good maybe that we look about maybe more explaining to the investor side, like why these risk warnings have to be there, what they mean, what the reason for them being there is, and what the FCA are trying to achieve by them. I thought it'd be good just to do that. And then the following week we'll be wrapping up with the review of the year, so you can get your thoughts all sharpened. And this is where you're at home. Talking about financial promotions and policies.
I mean, Karen and I covered the policy statement when it came out, and that was what that session was. And now we're starting to see the implementation, because the first deadline is today, December 1st.
Yeah, absolutely. So I think that'll be well useful to go through that for everybody. And again, makes a really good recording. So that is us for today. Thank you very much for those who have managed to join us. And the recording will be online again in about half an hour. But Sam, big massive thank you for being here. Appreciate that.
Thank you. Always a pleasure to spend time with you and John.
Yeah, fantastic. That'll do. Okay, you can put your big stick away, John, now for another week. I'll not feel all the pain of all the bumps.
Nothing in my hands.
All the best, everyone. See you next week. Bye-bye now. Bye-bye. Bye.